basically, they asked us to firstly describe the preconditions required for an audit. So these preconditions is also a question that they like to ask repeatedly. So maybe let's just do this. Let's do this juga, these preconditions. Since I've been like ignoring the other points, kan? Okay, let's try to cover more questions along the way. Okay, let's do the describing the precondition. Okay, next is we want to describe 7 audit risks and explain the auditor's response to each risk in planning the audit. Okay, so yeah, I hope that you guys can go through the scenario. Maybe I'll explain on this part here. Okay, on the preconditions before we go into the scenario. Okay, so because we have 2 different things before we actually accept our client. Okay, so those things are precondition and pre-acceptance. Okay, so there's a difference between preconditions and pre-acceptance. Okay, I want to bring you guys to the audit cycle. My notes are kind of like a little bit all over the place, so I'm macam Okay, so basically, before we actually sign the engagement letter, we will basically have to consider certain factors, okay, before we sign the engagement letter and agree to audit this client. Okay, so basically, these are the client acceptance procedure. Okay, and if I were to divide it, basically this point number 1 here is the preconditions, and these other factors here, okay, these 3 factors here are the pre-acceptance. Okay, so in the question just now, they're talking about these preconditions. Okay, so we follow the 3 plus 1. Okay, so the first is the use by management of an acceptable reporting framework, which is basically IFRS, and the management has to acknowledge their responsibilities in preparing the financial statements, establishing internal control, and providing access to all records and documents. Okay, so basically just explain this point here, okay, guys. And can I give you guys just like 10 minutes to just read through and prepare your answer plan. Okay, the question and the kotak-kotak for your audit risk and auditor's response. 10 minutes to go through the scenario and maybe to just summarize your points in the answer plan, and then we'll discuss together at 9:10, 9:15, 10 minutes. Okay, guys? guys, time is up. I hope that you guys have completed your answer plan just on like basically copy paste what are the audit risks from this scenario. Okay, maybe you guys can just tell me how many audit risks did you guys discover from these Corley appliances so far? Okay, how many did you guys discover? Let me share my screen. Okay, so I have actually discovered 9. There are 9 audit risks within this question, even though they actually just ask for 7. Usually, in most cases, they will usually give more. Okay, so when you guys are highlighting and looking through the audit risk, make sure to, before you guys actually start off, you guys should actually already pick which points that you guys feel are more confident in answering. Because usually there will be more than, okay, if they ask for 7, there will be more than 7 audit risks. Okay, just focus on the ones that you guys are more confident in answering. Okay, in this case, we'll just answer all. Okay, so let's try to answer this together, okay? I've made the audit risk table, audit risk punya answer plan. Okay, so the first one is basically on the return policy, allowing customer to return goods within 28 days of purchase. Okay, can somebody write in the chat box on basically what is the requirement as per IFRS 15? Okay, because this is something that we should probably be a pro in already, right, guys? What does IFRS 15 require us to do? What is the explanation for this point? Okay, if nobody's going to attempt, I want to try calling names. Maybe this is my chance to get to know you guys better, perhaps. Okay. Okay, so somebody reply. You know, I'm sent to recognize the refund liability. Yes. Okay, basically the point is to recognize revenue should exclude the refund liability. Okay, thank you, Ain and Aisha. So basically, as per IFRS 15, revenue should only be recognized to the extent that goods will not be returned, basically to exclude the refund liability. Okay, the company should recognize a refund liability for the goods which are expected to be returned. So the implication is basically if the company has not correctly accounted for this, then basically the revenue may be overstated and refund liability may be understated. Okay. Now, can somebody else try for the auditor's approach, since we've actually done this a few times already? Okay, even within the question, they talked about how historically 5% of customer return goods within the return period. Okay, so what is the auditor's approach if we want to talk about this 5%? Okay, Alia, do you want to try? What is the auditor's approach on this? Just try to, guys. Even if you guys get it wrong point, it's okay. Especially on the auditor's approach, I know that's the more difficult part. Okay, so basically the first thing is we want to discuss with management. Why do they actually put this 5%? Okay, we want to discuss with management on the rationale. Yeah, thank you, Alia. Discuss with FD on why they felt the estimated return rate of 5%. Yeah, because this is after all an estimate, right? We have to question how did they come up with this estimate? Did they just plug this figure or how? Okay, so basically we want to discuss with management on the rationale for the 5% estimated rate of return to assess the reasonableness. Yes. Okay. Review the return policy. I would say that this is a similar answer. We want to basically review the estimated rate of return. Okay. So another point is basically we want to inquire, or maybe I think that more specific, something that is very repetitive. Okay. We want to compare the level of post-year-end returns to the refund liability to assess reasonableness, and we want to discuss any significant differences with the management. Okay. Basically, we want to look at eventually how many returns have been made by the customers. Okay, and then we want to assess whether this refund liability is it reasonable or not. Basically, if there's a huge difference, we will have to ask management to amend this refund liability. Okay, next is on the warranty. Okay, the directors have reduced this provision on the grounds that they feel the products they sell are built to a high standard. Okay, this statement here is something we will question within our auditor's approach. Remember, guys, whenever the directors say anything, we will want to discuss with them. Why do they feel so? Maybe like that. Okay. So basically, I feel like the answer here on the auditor's approach is quite similar. Okay, for the return policy and the warranty. Okay, why do you guys think that the auditor's approach will be similar? What is the similarity between the warranty and the refund liability here? What is this?
Because both need provision.
Yeah, both are basically basically both are uncertain. They require a provision that is based on an estimate. So yeah, you're right. Basically, these are areas which are high in judgment. So this is something we have to discuss with the management more. Okay, so now we talk about warranty. We bring in as per IS 37. A warranty provision should be recognized for this 6-month warranty, and this is usually a highly subjective area. Okay, so what is the implication, guys? Basically, the implication is if they have not accounted for this properly, there is a risk that warranty provision are understated, leading to liabilities and expenses being understated. If the company has unreasonably decreased the warranty provision without proper justification. Okay, basically we have to kind of like scrutinize on their excuse here. Okay, they have reduced this provision on the grounds that they feel the products they sell are built to a high standard. So I think that is not a very proper justification now. Okay, so maybe we can basically okay, yeah, correct, Najwa. Understate provision, overstate profit. That's also something yang I mentioned just now, right? Basically, profit can be overstated. Okay, so basically, another thing kan, whenever there's a provision, kan, what is the point that I said just now? What can we basically do with this provision? Okay, okay, so I'm going to give 1 point first, which I said, like I said, is similar to the point up here. Okay, just now we compared the level of post-year end returns to the refund liability. So we're going to do the same thing. We're going to compare the prior year warranty provision with the actual level of claims made in the year to assess the reasonableness of the management reducing the provision. Okay. Second is we want to review the calculation. Yeah, like I said, whenever there is a provision, we can look into the calculation. Review the calculation of warranty provision and assess its reasonableness in light of the value of claims received in the period. Okay, so far so good, guys. Moving on to the next point here. Okay, I want to explain this in more detail because here is a bit confusing because of the wording. Okay, can you guys just while I share my screen, can you guys just like write in the chat box when will we basically recognize purchases? I salah share screen. When do we recognize purchases, guys? Okay, let me just okay. So basically, let me just okay. I want to explain on this point here. Okay, when goods, okay, some of you guys said when goods being received, when the goods have been ordered. Okay, let's basically look into this point here. Okay, even from the scenario kan, from the scenario, this is what they say, okay guys. Okay. They say that the company purchases their goods from its main supplier in Asia and has responsibility, okay, this point here, has a responsibility for goods at the point of dispatch. So the goods are in transit for up to 1 month. So in this case then, if I draw a timeline, okay, so right now this is maybe when the company, maybe the 1st of Jan, the company has placed the order. Okay, and so their goods will basically arrive at the central warehouse. Okay, I think from the scenario, they will arrive at the central warehouse. Okay, and then only then they will arrive to them after 1 month. Okay, yeah, central warehouse is the point of dispatch. Okay, and then only then it will arrive to the company punya warehouse. Okay, silap. So here is not the central warehouse. Point of dispatch is maybe the supplier punya, maybe like port, at the port. Okay, macam for example, if the items macam baru sampai dekat the port in China. Okay, so maybe we have placed the order on the 1st of January, and then they have reached the port or the point of dispatch as at maybe the 1st of March, and then after 1 month, okay, from China punya port, baru it will finally arrive to us, which is basically the company punya warehouse, as at 1st of April. So among these three, when will we recognize these purchases? What do you guys think? Okay, so most of you guys said 1st of March. And some of you guys said 1st of April. Okay, usually we would recognize it as at the 1st of April. However, in this case, because of this statement where when it has reached the point of dispatch here, then basically the responsibility for the goods is within the hand of the company. What is the name of the company? Hurley Appliances. Okay, so that is where it is very confusing here, right? Okay, so basically, once they have arrived at the point of dispatch, even though it has not reached the company's warehouse here, and we have not received the item. However, because they already take over the responsibility and the rewards of the asset, as at this point of dispatch, which is the 1st of March, the purchases should actually be recognized on the 1st of March instead of the 1st of April, which is when we receive the item here. Okay, so that is the very confusing point here. Okay, this point here, usually it will be when we have received the item. But I think the more specific sentence of when we actually recognize a purchases is actually when we have obtained control over the item, or basically we have obtained the responsibilities and rewards of this asset here. Okay, so basically we have obtained the responsibility and the rewards for the goods at the point of dispatch, so we should have recognized for it on the 1st of March. So the risk right now is that the company is not accounting for this appropriately. Okay, so what are we supposed to do at 1st of March? What is the double entry here, guys? Okay, what do you guys think is the double entry as at the 1st of March? Okay, for example, maybe they have only received the invoice at this stage juga. Okay, let's say if they receive an invoice as at the 1st of April, what is the double entry as at the 1st of March? And what is the double entry as at the 1st of April? Okay, can you guys try? What is the double entry for the 1st of March? Okay, so as at the 1st of March, we will debit purchases, credit accruals. Yes. Okay, we will basically debit purchases, credit accruals. Okay, what does this mean when we basically credit accrual? And usually we will credit payables, correct? Okay, however, payables, we will only recognize the payables when we have received the invoice. Only when we have received the invoice, then basically the obligation to pay for this has arrived. Okay, only once we have received the invoice here, okay, this is basically the 1st of March, this is what we will account for. And then on the 1st of April, when we receive the invoice, we will basically cancel out these accruals. So we will debit balik these accruals, and then only then we will credit payables. Okay? So basically, this is the double entry here. Okay, this is how it's very confusing, right, guys? Okay, so far, do you guys understand? And do you guys understand why we credit accruals instead of a payables? The difference is basically we will only recognize a payable when the invoice has been issued. Okay? If we have received the item, but we have not received the invoice, we will account for this as an accrual. Only when we receive the invoice, we will basically cancel out by debiting this accrual, and then we will account for it as a payable. Okay? So this is basically very confusing, this question here, right? I just wanted to explain to make sure you guys know what is the correct accounting treatment in case this comes out in your exam juga. Okay, so let's finally discuss it in our, how can we word this together? Okay, so basically, let's talk about what is the correct, what is the risk lah, okay? That is a risk. Maybe we talk about what is the correct treatment, right? We should account for these purchases at the point of dispatch. Okay, so basically, the company should recognize the goods as purchases from the point of dispatch. Okay, there is a risk that purchases are not recognized accurately in the correct accounting period. Okay, basically because of the cut-off issue. Okay, so yeah, because maybe they wrong account for it in the wrong accounting period because of this 1 month duration there. Okay, if it happens, if the whole thing I just now I showed you guys to happen within the same year, then that's okay now. Okay, however, if it is basically maybe the point of dispatch happened in December, but the goods actually arrived at the warehouse in January. So for example, in that case, then the company will account for it in the wrong, may have accounted for it in the wrong accounting period. So purchases, okay, the impact here is that the inventory and trade payables may be understated at the year end. Okay, inventory, purchases, and trade payables may be understated at the year end. Okay, because of this cut-off error. Okay, so this is mainly an issue on cut-off. So for the auditor's approach, we are going to do a detailed cut-off testing. Okay, on the purchases of the goods at year end, and maybe we will look into the sample. Okay, detailed cut-off testing on the review of purchases, on the purchases of the goods at year end, and review the shipping documentations immediately before and after year end relating to goods from the main supplier in Asia to ensure the cut-off is complete and accurate. Cut-off of purchases and payables is completed and accurate. Okay? And then maybe we want to discuss with management if they are accounting for this correctly or not. The point at which inventory is recorded, and review the contract with supplier to verify requirements in place. Okay. Okay. So far, so good, guys. Do you guys have any questions on this point? Can I move on to the next point? Okay, guys? Alright.
Miss, kejap.
Yeah?
Tak habis salin.
Oh, okay, I naik atas. Okay, you guys salin dulu. Okay? Korang salin dulu. Okay, can I move on to the next point? Did you guys get it?
Yes.
Okay. So next point is the company's central warehouse and all 20 branches will be carrying out an inventory count. Okay, so what is the explanation? What is the risk here? When there are 20 branches carrying out an inventory count at the same time, it may be that the auditors cannot visit all of these inventory count sites. Okay, it is unlikely that the auditor will be able to attend all sites. So the risk is they may not be able, it may not be possible to obtain SAE over what? Okay, to obtain SAE on what? Be very specific. To obtain SAE over the inventory count controls and the completeness and accuracy over inventory balances, which are over inventory sites which are not visited. Okay, so what is the implication here, guys? What is the risk here? What can we say about this?
Detection risk.
Yeah, there is an increased detection risk over the inventory balances. Okay, or you can also say there is a chance that the inventory may be misstated. Okay, so basically it's the same point like just now. Okay, guys, I'm just repeating my point. Audit team to assess which sites will they visit. Okay, so somebody tanya SAE tu apa? Okay, I'm sorry. Okay, I think I selalu just like shortcut. So SAE is, okay, I'll just write the full point. Sufficient and appropriate audit evidence. Okay, appropriate evidence over the inventory control counts and the completeness and accuracy over inventory sites which are not visited. Okay, so basically we will assess which inventory sites they will attend, mainly focusing on the ones with material inventory balances or higher risk of material misstatement. Okay. Okay. So for the inventory counts, which auditor will not attend. Okay, what are the things that we will basically do, guys? Okay, can you guys recap on this, because we went through this together just now? There are basically two things, okay, three points here for the inventory counts which auditor will not attend. What is it? I'm just going to put Shani. What is the first point? Firstly, we want to review the documentation relating to controls surrounding the inventory count. This is the first thing. Second thing is we want to basically review any exceptions noted during the count. Exceptions is maybe, for example, the inventory count sheet actually records there is, let's say, 50 shelves or 50 inventory, okay, 50 units of inventory, but physically when they counted, there's only 40. So there's a discrepancy between the inventory sheet and the physical inventory. So we want to review all these exceptions noted during the count. And lastly, we want to discuss with management on any issues which arose at the count. Okay, so this is a very typical answer, especially on inventory count. Inventory count ni pun, as you guys notice, has been repeated in a few audit risk questions that we have attempted just now. Okay, so next point is the receivables. Okay, the receivable collection period has increased. Okay, and the allowance for receivables will be the same level as the prior year. Okay, I don't want to do this point because I think it's repeated. So can you guys help me out? What is the explanation here? Just like a simple explanation for this point and the implication. Okay, can somebody try? This is a very repetitive. Almost every year they will like, this should be a bonus audit risk for you guys already. Okay, should get 2 marks for this. Hello, anyone want to try? Okay, so okay, Azimuddin said there may be bad debt will not be recovered, and higher risk of irrecoverable debts. That's correct. Recoverable debts or maybe bad debts. Okay, the implication is that the receivables may be overstated and the allowance may be understated. Okay, thank you guys for attempting. Okay, now let's go to the auditor's approach. Okay, again, I do not want to give you guys the answer for this because I have repeated it like for every question, mesti ada these 2 points. What are the 2 points when we're talking about auditor's response on the receivables? Okay, there's 2 points here. Okay, can anyone try? Okay, so you guys said review the age debtor analysis. Yeah, okay, it comes as a set, guys. You cannot just review the age debtor analysis, right? We have to review the age debtor analysis to basically review the outstanding receivable balances, and then we want to discuss with the, okay, there's two people that we can discuss with here, okay? Okay, that is the FD. Okay, discuss with FD. Okay, so I said the need for increase in allowance. If we want to talk about the need for increase in allowance, we will discuss this with the finance director. Okay, discuss with FD on the need for increase in allowance. Another thing, if you guys want to discuss on the likelihood of the customer making the payment, this is something we will discuss with credit controller. Yes, Mimi? Yeah. Okay, so you have to also know who is the personnel that you want to discuss with in this case. Okay, because the credit controller and the FD, the finance director, they have different roles. Okay, we cannot discuss the need for increase in allowance with the credit controller actually, because they are not in the suitable position to be doing this. The role of the credit controller is just to chase the outstanding payments and determine the likelihood of the customers making the payment. Okay, the other point is basically we are going to do extended post-year end cash testing. Auditors should inquire with the management reason why they did not revise the allowance for receivable in the current year. I think we can talk about that too. But I would say that in this case, okay, if we want to inquire with management, okay, this point of discussing with management should be only if you have no other strong audit evidence. Then we can inquire with management. However, if there is like strong audit evidence to back this up, we will basically focus more on the other evidence. Okay, Alia? So I will basically include your answer, okay, because it is reasonable, but this should be your last point. Okay, especially when we're talking about receivables. In this case, there are other points that you guys can give. Every single question on receivables is the same thing over and over again. Oh my god, I just realized that I put it in the wrong column. Should go here. Okay, auditor should inquire with the management on why they chose to not revise the allowance for receivable for the current year. Okay, inquire. I think this is basically the same point as discussing with FP on the need for an increase in allowance. Okay, actually, you should combine this answer with reviewing the age debtor analysis. Okay, so the next point is basically for us to do, extended post year-end cash receipts testing. This is basically when we will review the cash book and cash receipts within the bank statement. Basically, for us to, what is the purpose is to confirm the valuation of receivables and the need for an increased, and basically assess the need for an increased level of allowance for receivables. So a level code, increased allowance for receivable. Okay? So these 2 points here, I want you guys to have fun and take with you, because this can actually be used not only for your auditor's approach, but you can also use it if the question were to ask you on, let's say the question were to ask you on the substantive procedures on receivables balances. Okay? If it is very vague like this, then you guys can actually talk about these 2 points for your substantive procedures juga. Okay? So really remember these 2 points. All right, so let's move on to the next question. Next point. Payables ledger supervisor was dismissed due to a fraud. The value of this fraud has been recognized as an expense. Okay, basically, it's just the same issue here right now. The additional fraud committed by the payables ledger supervisor may still be unidentified. Basically, dia punya full impact is still undiscovered. Okay, so the implication is this could lead to expenses being understated and payables being overstated. Okay, another thing that we can say is there is an increased control risk if the fraud has gone undiscovered or undetected for a period of time. Okay, so either one will do. Okay, so basically what is our point here, guys? What is the 2 audit approach that we can talk about in here? Just like pendek-pendek pun is okay. Okay, we want to basically maintain professional skepticism, right? Because the key point here is fraud. So we want to maintain professional skepticism and be alert to risk of further fraud. Number 1. Another thing is we want to undertake additional substantive procedures. Okay, this point here, we can only use it when we know which specific area that they possibly committed fraud in. Okay, so usually I don't put this point in because the fraud is like it can be anywhere. I'm going to talk about this point because here dia dah cakap, they have clearly stated that the payables ledger supervisor had committed this fraud and this happened within the payables. So right now, we are basically going to increase our testing on the payables. Audit team should undertake additional substantive procedures over the payables balances, particularly the fictitious suppliers being set up on the payables ledger to ensure this has been removed. Okay, this is how I applied it to this scenario. Okay, if you want to talk about additional substantive procedures, make sure it's specific to which area. Okay, and as per usual, whenever there's a fraud, we want to maintain professional skepticism. Okay, next point. Purchase invoice has yet to be logged onto the payables ledger. Okay, basically this is a based on the incompleteness. Okay, there is an incompleteness of the purchases and payables. Okay, so there is a risk that purchases and trade payables at the year end will be understated if these invoices are not logged onto the payable ledger before it is closed down for the year. Okay, so basically the risk is that, so that's pretty much it. Okay, so I would say that this point here is not very strong. Okay, usually I feel like if you have a choice, maybe don't take this point. Okay, especially the auditor's approach point is like not something that we usually see. Okay, we want to look at the ones that have yet to be logged. We want to look into the purchase invoices that have not been logged yet. Review the unprocessed purchase invoices file at the year end, and then we want to identify any invoices which relate to supply of pre-year end goods and ensure they have been properly accrued for in the year-end financial statements and recognized as a liability. Okay, so what does this mean, right, guys? This goes back to our concept of purchases and accruals, like just now. Okay, so if I were to explain this, okay, hold on, guys. Okay, stay strong, guys. We are going to go through maybe just one more question. We're just going to finish this up and then we're going to take a short break. Okay, so what am I going to draw? Okay, so let's say again, in usual cases, and let's say this is the timeline and this is the year end right now. Okay, and let's say this is when we make the purchase order. Right now we're talking about purchase order. Okay, this is the year end of the company, and maybe we have received the item here. Let's say we have received the item before the year end, and then basically we only maybe receive the invoice after the year end. So as at year end, what will we recognize for these purchases? Can you guys tell me what's the double entry for these purchases here when we receive the goods? When we receive the goods, what is the double entry there? Okay, so basically we will debit purchases, credit accruals. Why do we basically credit accruals? Is because the invoice has yet to be received. We will basically recognize an accrual when the item that we purchase has been received, but invoice has yet to be received. But invoice, not yet. Okay, so after the year end, basically we are going to debit out these accruals. When we receive the invoice, only then we will basically credit the payables. Okay, so that's what it means in our scenario just now. We want to make sure that they are accounting for this correctly or not. Okay, guys? Okay, so let's go back to the scenario. Okay, so yeah, we want to review the purchase invoices file and we want to look at, we want to confirm whether this has been properly accrued for. Okay. Next is basically on the new dispatch system. Okay, the costs which have been capitalized include staff training costs. Okay, this is not correct, right? Because basically we should only include costs that are directly attributable. Okay, so let's talk about it here. Okay, the training costs. Okay, usually what people will do is, as per IAS 16, costs should include directly attributable cost only. Okay, and then baru you come into the point where the cost about the staff training cost is not a directly attributable cost and should be excluded. How can I fix this to be more, basically to be more, we want to apply immediately instead of wasting our time explaining the standard here and not getting any marks. Okay, so let's immediately apply. The training cost should not be included as part of the cost of the asset, as it is not directly attributable to the bringing of the dispatch system to its working condition as per IAS 16. Okay, so maybe this is how you guys can word your sentence better. So we want to immediately apply to the scenario instead of spending our time on basically doing two things. Okay, usually what we will do is explain the requirement and then we apply. So I want you guys to immediately apply. Okay, so basically it should be expensed off to SOPL instead. So the implication here is that PPE and profits may be overstated, the expenses may be understated. Okay, guys? So maybe we want to discuss on the accounting treatment. Okay, we have to basically, in this case, because the management is doing something wrong, we want to advise them on what is the correct treatment. Discuss the accounting treatment, the correct accounting treatment treatment with the FD and request that training costs are written off to SOPL to ensure treatment is in accordance with IS 16 PPE. Okay, basically we will review the correcting journal entry for accuracy. Okay, if there was a mistake, we want to confirm whether the management has actually corrected this or not. That's why we will review the correcting journal entry. Okay, guys, so we are at our last point. Okay, so the last point is basically on the overdraft, right? Okay, so the company breached the term of its overdraft, and basically the bank is still not sure whether they will continue to provide this overdraft or not. So what is the explanation here, guys? Why is this a huge risk that we want to talk about? Okay. So yeah, Mazan said on the auditor's approach, we will do a going concern testing. Okay, this is basically when they talk about the overdraft here, this is actually an indicator that the company may have uncertainties on their status as a going concern. Okay, if the bank refuses to continue this to support the business through the overdraft facility, there may be significant doubts as to the company's ability to continue as going concern. Okay, so when there is a going concern, what do we have to do? Okay, what does the management have to do if there is an uncertainty on going concern? Okay, this is based on the actual legislation. Okay, basically, the company has to disclose these uncertainties on their going concern status. Okay, so basically, if they are not disclosing this properly, okay, if the going concern is if the disclosure on going concern is not adequate, okay, basically we just say lah, okay, the uncertainties on the company's going concern status may not be adequately disclosed in the financial statements. Okay, so Mazan asked where the disclosure should be made. Everything, the disclosures will be made within the notes to financial statements. Okay, if you guys remember, whatever after the financial statements, there will be a disclosure which is within the notes to financial statements. So basically, the company will have to kind of state that there is a uncertainty on the going concern, and they will explain, okay, this comes from the overdraft facility. All right, Mazan? Basically, we just have to make sure, we as the auditors have to make sure whether did the management actually account for this disclosure within the notes to financial statements or not. Okay, so basically, first things first, we want to review the adequacy of any going concern disclosures in the financial statements. And like Mazan said just now, we as the audit team should undertake detailed going concern testing, in particular, reviewing the cash flow. Reviewing the impact of the non-renewal of overdraft facility to company's cash flow and ability as a going concern. Okay. Lastly, maybe we can discuss with FD on availability of alternative financing. If the bank chooses to withdraw the overdraft facility. Okay. So have you guys gotten the points? Okay, so now is 10:03. Basically, since we have actually covered two audit risk questions, okay, do you guys think the progress is okay? Am I going too fast? I feel like I want to cover one more question after this before we end our class tonight. But so far, is it okay? All right, is my progress like okay for you guys? Okay. Miss nak tanya if time exam nanti lupa pasal IAS semua tu, but explanation okay still kurang markah ke? Okay, so somebody tanya kan, if you tak if basically you forget on the IAS. Okay, this is a real concern. Okay, this is definitely a real concern because at this stage maybe you guys are not so sure on the IAS. Kan? For example, kan we say as per IAS 16. So if you guys omit this point is okay. Alright, actually it's even better if you guys, okay, it's better for you guys to just not write it if you guys are not sure. Because if let's say kan you put in the wrong accounting standards kan, then maybe the maybe the examiner will reduce your marks. Okay, for example kan, here on the training cost kan is under PPE. Okay, and then maybe you're not sure kan, and then you put as per IAS 38. IAS 38 ni is on intangible assets, right? So maybe the accounting treatment is different under this accounting standard. So dekat situ, if you guys get it wrong, maybe the examiner will cut down on your marks. So if you're not sure, then just immediately go into the explanation. Okay, at this stage, at AA stage ni, it's not like a must lah. But of course, they would like it better if you put the accounting standard, but it's not a must. Yeah. So Azim cakap boleh cakap relevant accounting standard boleh ke? Yeah. So I think this is more safe juga. Another way we can say kan, if we are not sure kan, we cakap to ensure, example ni kan, to ensure treatment is in accordance with IAS 16 PPE kan. Okay, but you guys don't remember kan what is the accounting standard? To ensure treatment is in accordance with relevant accounting standards and maybe local or maybe legislation, laws and regulation. Okay, so this is how you guys can word your sentence if you do not remember what is the correct accounting standard to apply. But better for you to say IAS 16 PPE lah, like that. Okay, so yeah, don't worry about these small details. As long as you guys get your explanation right, then inshallah these small details the examiner will not really cut your marks for lah. However, in triple A later on, if you guys are planning to take triple A, I think it is a requirement for you to actually have the correct accounting standard. Okay, but at this stage, it's not a must. All right, so you guys got so far so good. All right, okay. So I hope that everyone is on. Like we've completed 4 questions already, right? So far, are you guys feeling a bit more comfortable in answering your audit risk questions? Okay, good. Macam, are you guys seeing the flow a little bit? Okay. So Marini said yes. Okay, Iman said yes. I hope so too. Because okay, I know that the issue can is that sometimes when we are doing questions, we confuse on our answering technique for like audit risk, for SP, for internal control. Basically, they all sound kind of the same. Betul tak? Okay, it's true, right? Sometimes kan, the way we answer for all 3 of these questions are similar. Okay, that's why we have to make sure our exam technique is important. Because if you do not get the exam technique right, you will basically kind of mix up your answers. Okay, and that is where you will lose marks because you are not applying to the scenario and you're not answering the question. That is how you will fail your audit. So I would say that exam technique is so important in audit. It's not even about the knowledge sangat. If you guys notice kan, some of the points are very repetitive. Okay, the points are very repetitive. So some of the points I did not even have to go into detail, right, guys? Because we have basically repeated it. Okay, so all right, maybe we can take like a short 15 minutes break. Okay, and then I'll see you guys at what time? Yeah, I'll see you guys at 10:25. Okay. All right. So somebody said you want to see the warranty notes. Warranty notes dekat mana? Is it in this question? Iman, is it this question? Let me go up. Okay, this one, right? Warranty provision. Okay. This point, right? My notes. Ni je kan? Did I make? And oh yeah, my notes. Okay. Let me show my notes. Okay, and Alia said upload video every after class ke? Basically, our admin tu will usually upload by the day after lah. Usually by the day after pun dah uploaded. I think yesterday punya recording pun is already up on Timba Flags. Okay. So sekejap, Iman, let me just share my notes tadi tu. Okay, so you guys can go on your break first. If you guys want to see my notes pun boleh je. I'm just going to continue sharing my screen in case you guys want to copy. Okay, is this one right? Okay, so you can just copy it first. Okay, I'll see you guys at 10:25. Okay, hi guys. Are you guys back from your break? Okay, let me share my screen. Okay, basically the last question that we'll be doing. Okay, I hope that all of you guys are still here. Okay, can you guys just like comment on the chat just for me to see whether you guys have actually returned from your break? Okay. All right, Najwa is back. Okay, so you guys can access our final question, which is Pony. Okay, look into your Timba flags. I have already uploaded it. Have you guys downloaded it? You just download the question Pony Co. I have already uploaded it in your Timba flags. Okay, so let me just share my screen and then we're going to discuss this final question. And then I want you guys to attempt this like it's your actual exam. Okay. All right, so think of this as kind of our last question as like a closing for our audit risk punya session, okay? Because after this, we will be next week we will be covering on internal controls, and the week after that we're going to look into substantive procedures. So this is the last question on audit risk, and this will be kind of like an indicator of how well you guys have understood whatever you've learned within these 2 days. Okay, guys. So even though it's 2 days here, I think we've like made the most out of it, right? So I hope that you guys can attempt this properly as if this is your actual exam. Okay, do the auditor's risk and the audit approach. Okay, but before that, we will discuss the question together first. Okay, so let me just share my screen. Okay, so skipping on this. Okay, so on the question of Ponyco. Okay, first things first, we're going to look into the requirement. Okay, they ask us to describe 8 audit risks and explain the auditor's response. So that is 2 requirements here, right? When we describe again, guys, do not forget to explain and talk about the impact to your business. I mean, impact to the financial statements. Basically, which specific area is being affected. Okay, I want you guys to answer with the format that I taught you guys. And when we are explaining the auditor's response, this means we want to talk about what is the purpose. Okay, why are we doing this auditor's response? What are we trying to achieve here? Okay, so let's look into this scenario together. You are an audit supervisor of Daffodil Co. and are planning the audit of Pony Co. for the year ending 31st May. Okay, make sure you guys highlight or underline the financial year end because this is important in actually reading through your scenario juga. Okay, so the company is a food retailer with a large network of stores across the country and 4 warehouses. The company has been a client. Okay, they give you the profit before tax. Okay, next, Ponyco has an internal audit department which undertakes control testing across the network of stores. Each store is visited at least once every 18 months. The audit manager has discussed with the FD that the external audit team may rely on the controls testing, which is undertaken by IA. Okay, so this is the first audit risk here. Okay, when we are considering whether we can rely on the controls or not, there are some things that we have to take into consideration. Basically, we want to look into whether the IA have actually, first things first, we want to look into their independence, okay? And then we want to review the extent of work done by the IA, whether this is appropriate for our audit or not. And basically, we want to talk about the competence of the IA, of the internal audit department. Okay, so these are some factors that we have to consider lah. Okay, and another thing is, okay, the store visit is only once every 18 months. Okay, this may be a very long time here. Okay, so each store is visited at least once every 18 months. Okay, so there can be deficiencies in the internal control that may be unidentified or undetected because they only visit the stores once every 18 months. Okay, so dekat situ I've already hinted to you guys, right? Okay, so the next point, the FP provided some forecast financial information. Revenue is expected to increase by 3%. The gross margin is expected to increase and the operating profit margin is expected to decrease. Okay, so again, guys, whenever they give you this, okay, make sure to apply it in your audit risk answer. Okay, so even here, you guys can actually give one audit risk point. Okay, you can actually question why is it that the revenue has increased and the gross profit margin has also increased? However, the operating profit margin is predicted to decrease. Okay, this is actually the second point here. This is the second point here. Basically, it may be that the costs are classified incorrectly, okay? Because maybe there is a wrong classification of costs. Okay, so for example, how does it look like, right? Basically, it would be like the sales minus cost of sales, and then we get your GP, right? And then we will basically minus the operating cost. Tak mood lah, guys. Okay, basically we will minus sales minus cost of sales, and then this will get the GP, and then we will minus whatever, what is it just now? Minus whatever operating cost, and then we will get operating profit, right? So maybe they have incorrectly classified between the cost of sales and the operating cost here. Okay, so this is the second risk here. Third is basically Ponyco values inventory in line with industry practice, which is to use selling price less average profit margin. Okay. Directors consider this to be a close approximation to cost. Okay, what does IAS 2 say? Okay, what is the requirement as per IAS 2, guys? Recap. What does IAS 2 say? Okay, basically, like you guys said here, okay, so Azimuddin said lower of cost or NRV. Yeah, you guys are correct. So basically, selling price, okay, selling price minus cost, we will basically get the profit, right? So basically, selling price minus profit is actually the cost, right? Okay, in this case. So basically, the company is actually valuing the inventory as at the cost. Okay, so however, they consider this to be a close approximation to cost. The audit risk is basically we want to confirm, is it really a close approximation to cost, or basically there is a risk that the inventory may be misstated. Okay, so that's the third point here. You want to talk about what this IAS 2 states. The company does not undertake a full year-end inventory count and instead undertakes monthly perpetual inventory counts, each of which covers 1/12 of all lines. Okay, it only covers 1/12 of all lines in stores and warehouses. And an audit junior attended a perpetual inventory count and noted there were a large number of exceptions, where the inventory records showed a high quantity than the physical inventory which was present in the warehouse. Okay, and this had been a recurring issue. So this is all here. You guys can summarize it into one point. Okay, so there is when we talk about here, what is the risk, guys? When the company basically are only undertaking a inventory count at only 1/12 of all lines in stores. Okay, basically there is a risk of, there is a detection risk. Okay, when we talk about detection risk, let's bring again that basically the explanation should be, we are unable to obtain sufficient audit evidence. Remember, we are unable to obtain STE on the inventory records. Okay, that will basically cause the increased detection risk. Okay, and then basically which account is being affected here, right? We can say the inventory may be overstated. All right, so this is point number 4. The next, during the year, IA performed a review of the NCA physically present in around 1/3 of the company's stores. A number of assets which had not been fully depreciated were identified as obsolete. Okay, a number of assets which had not been fully depreciated were identified as obsolete by this review. Okay, if the asset had not been fully depreciated but they are identified as obsolete, this means that their depreciation policy is not good enough. Basically, there's something wrong with their depreciation policy. So for the auditor's approach, what we can do is maybe discuss with the management on how do they depreciate these non-current assets. You want to look into the method. Okay, guys? So basically, we want to question how are they calculating their depreciation, and maybe we want to look into the IA reports. Okay, in this case, IA has actually performed a review. So whenever the internal audit team have performed a review, automatically there will be a report. Okay, and when we are talking about a report, we want to talk about specifically what report. The report on the review of the non-current assets physically present in the company stores. Okay, the next point is the launch of a significant TV advertising campaign in January in order to increase revenue. Okay, the directors have indicated that at the year end, a current asset of 0.7 million will be recognized, as they believe that the advertisements will help to boost future sales in the next 12 months. Okay, so they are basically recognizing a current asset of 0.7 million. This advertising campaign is in January 20X9. Okay, So what do you guys think of this? Is this correct to be accounting for this as a current asset? Okay. Is it correct for them to recognize it as a current asset? Is this valid? Okay. Okay, so this should be expense of, yes. So Ifa said that this is basically an advertisement expense. That's correct. Basically, this 0.7 million, the correct treatment is to be expense of. Okay? In accordance, basically, we will only capitalize this as an asset if there is a probable inflow of FEB. You guys remember, right, the definition? Probable inflow of FEB, that can be, another criteria is that it must be able to be measured reliably. If they do not meet this criteria, then basically we are not supposed to capitalize this. All right, so that is the next point here. This is number 6. Okay, only co-decide to outsource. Okay, every time we outsource to an external service organization, this is basically the same point here. Okay, this service organization handles all elements of the payroll cycle and sends monthly reports to Ponyco. Okay, so this is one point here. Okay, if you guys remember, we did this in our previous question, right? So whenever we outsource a function, especially the payroll function, to an external service organization, what is the risk, guys? What can you guys say about this? What is the risk that will arise from outsourcing this payroll function to an external service organization? Okay, so Azimuddin said there is an increase in detection risk. Okay, yeah, that's correct. There is possible increase in detection risk because we are unable to obtain, it may be difficult to obtain SAE, sufficient appropriate audit evidence. Okay, on the, basically at the end of the day, it may be that the wages and accruals, the wages expense and accruals may be misstated. Another thing that you guys can say is basically, okay, right now we are giving this external service organization the responsibility of actually taking the responsibility of actually counting and basically doing our payroll, right? So basically when we are giving this responsibility to this external service organization, we have to make sure that they have appropriate controls in place. Appropriate controls plus monitoring of controls over their payroll. Okay. So that is the 7 points. So again, this is actually, this point here is actually hinting you guys. So they send monthly reports to Ponyco. So you can use this as part of your auditor's approach. Okay, we can basically review this monthly report from the external service organization. And if you guys remember from the last question that we did together, we can maybe request for a type 1 or type 2 report from the external service organization. Okay, so this is number 7. Okay, Ponyco maintained its own payroll records until 31st December, at which point the records were transferred to the service organization. So I think you guys can break down this into 2 different points. Number 8. Okay, whenever there is a transfer of records, there may be an error or maybe an omission in the records. Okay, so whenever there is a transfer, there may be omission or maybe errors in this transfer. So that may actually cause the payroll to be misstated. Okay, that's point number 8 here. Next point is they are planning to expand the company, and in order to finance this, in March to X9, the company obtained a 3 million bank loan. Okay, this is repayable in areas over 5 years in quarterly installments. Okay, so you guys should be a pro at this, right? What can we talk about this? What is the explanation for this loan? Why is this an audit risk to us? Okay, so let's see your answers. Okay, the split between CL and NCL. Okay, so there's 2 things that we can talk about here. First things first, we can talk about the split, or basically there's 3 things. Split between NCL and CL. We can talk about the disclosure, and we can basically talk about the finance charge, all right, the interest. Okay, so there's 3 things that you guys can talk about here. Okay, maybe for the auditor's approach, you can actually obtain the loan agreement because we want to confirm, is it is it accurate or not? Okay, when you guys are giving the auditor's approach, try to apply to the scenario. So we want to obtain the loan agreement and confirm whether confirm the amount of the bank loan of 3 million and the terms of the bank loan repayment. Is it really over 5 years or not? Okay, so this is point number 9. And on the last point is, in preparation for the expansion, the company is looking into streamlining its operation and is planning to make approximately 60 employees redundant after the year end. So this is a subsequent event. Okay, subsequent event is basically any events between the financial year end all the way to the date of auditor's report. Okay, this is a subsequent event. So 60 employees will be made redundant. No decision has been made as to when this will be announced. It is likely to be in May 2009. So we have to actually look into this date. Is it before the year end or when is it? Okay, so the year end in this case is 31st May 2009. Okay, so basically they are planning to make the announcement in May 2009, which is before the year end. Okay, so this is the last point here. I want to recap a little bit. Okay, in accordance to IAS 37. Okay, this is basically IAS 37 on provision, contingent liabilities, and contingent assets. Okay, let's recap a little bit. Do you guys still remember your IAS 37? Okay, so usually when we bring in IAS 37, the most important thing that you have to know on IAS 37 is this restructuring provision. That's number 1. And the second is basically on the, yesterday I showed you guys the table. Okay, so let's look into the restructuring. Okay, when do we basically recognize a restructuring provision? Okay, the first thing, this restructuring provision should only comprise of costs that are directly attributable to the restructuring. For example, retraining costs is not a should not be included. We should only include directly attributable costs. Okay. So another thing is, we will only recognize this restructuring provision, okay, when they meet certain terms. Okay. So number 1, okay, we have to meet these 2 terms. You guys still remember what is the terms? Can you guys tell me what is the term? The first term is basically a detailed formal plan. Okay, what's the second term, guys? Recap on your IAS 37. Okay, not and or. It has to be both. We have to have a detailed formal plan, and basically the next thing is we have to, basically there is a constructive obligation. Okay, how does this constructive obligation arise? Is maybe through 2 things. Okay, either we have implemented the restructuring plan, or maybe we have made a public announcement. Okay, so that's why I said just now from this scenario, right? Basically, we want to look into when are they actually making the announcement. So in this case, the announcement was made in May 2009. So they have basically met the criteria of having a detailed formal plan, because they have already planned that they will make 60 employees redundant after the year end. This is basically to indicate that there is a detailed formal plan. And basically the constructive obligation has arisen from this because they have made a public announcement. So as at the year end, we have to make sure that the company actually recognize a provision for this redundancy cost. If not, provision will be understated. Okay, guys? So this is basically the issue on restructuring provision as per IAS 37. Okay, guys? So can you guys try to attempt this question? Maybe I will handpick which question I want you guys to do. Okay. I want you guys to do question number 2. Okay, this one here. This question here. Okay. Maybe I would this question here this is number 1. On the gross margin expected to increase and the operating margin decrease. So that's the first point. Second point I want you guys to try to attempt is this point here on the inventory. Okay. And then this is the third point. And fourth point is on the TV advertising campaign. Okay. And fifth point is on the external service organization. Can you guys just attempt these 5 points? Try your best to do explanation of the audit risk and do not omit the auditor's approach. Okay, just even if it's irrelevant, try your best. Okay, and maybe we will discuss this at 11:10. I'll give you guys 20 minutes starting from now. I'm going to turn on the timer. Okay, so please attempt these 5 points that I have listed down here, and I will see you guys at 12:10. Okay, guys, your time is up. Please submit your answers to the Padlet for those 5 points. Okay, did you guys manage to complete within the time? Okay, so this time attack, this form of time attack is very important because when you guys are actually attempting the questions yourself, it's easy to be carried away. Even if you guys set a timer, most of the time we will basically not be able to complete it within the set time limit. So always when you guys are trying to attempt the questions, make sure for every mark you should only take 1.8 minutes maximum. Okay, try to time yourself like that. Okay, for example, in this question kan, it's actually if 5 points, that means that's 10 marks already, right? So 10 marks times 1.8. So actually I have given you guys extra 2 minutes already. Okay, supposedly you have to complete it within 18 minutes only. So please submit your answers and then we will discuss together. Okay, so let me share my screen. Okay, let's look at the first answer here. Okay. Okay, let's look into this answer. Okay, gross margin is expected to increase. There might be a risk that the cost of sales contain misstatement. The cost of sales also might be wrongly classified. This will lead to the overstatement of the cost of sales. So you didn't also like bring in on the operating cost. So I feel like it's a bit incomplete here. Okay, so wait, let me just put this side to side. This is my answer. Okay, so basically you have to firstly state that there is an inconsistency between this increase of GM, of the gross margin, and the decrease in the operating profit margin. Okay, there is a risk that cost may have been omitted or included in the operating expenses rather than the cost of sales. So then the misclassification of asset would result in the understatement of cost of sales and overstatement of operating expenses. So I think this point here I can only give 0.5 marks because you didn't like also take into consideration the operating costs. You only talked about the cost of sales. Okay. Obtain the breakdown of the cost of sales and ensure that it is classified correctly. Okay, so this is actually correct already. You use my technique now and you obtain a breakdown of the cost and ensure that it is classified correctly, correct? Okay. However, basically you didn't state pasal the operating cost. So that is the missing link here. I think I will also give this a 0.5 marks. Okay, how can we correct this is maybe you can obtain the breakdown of cost of sales and operating expenses. Okay, and compare to the prior year and ensure and confirm that the classification between the costs has been made correctly. Okay. Okay, maybe compare to the prior year ni tak payah pun tak apa. We can confirm that the classification has been made correctly. Okay. Basically, this is next is on the inventory, right? IS2 states that the inventory should be at lower of cost, and NRV, there is the risk that the valuation is not correctly valued at the close approximation to cost. This will result in inventory being overstated. I can give this 1 mark. Okay, recalculate the valuation of inventory and compare with management valuation. Okay, basically, this is correct. Maybe how you can make this more complete is we want to talk about why we're doing this. So I will give this 0.5 marks. How you want to add on to this is basically to ensure that the inventory, that the company's technique of valuing inventory at a close approximation to cost is reasonable or not. Okay, is reasonable, or maybe you can say that the inventory is valued accurately. Okay, so remember to put in the purpose of your auditor's approach. So like I said just now, right, guys, I want you guys to really hafal this point here. Because every time there is an inventory punya audit risk, you guys can use this repeatedly. Testing should be undertaken to confirm cost and NRV of inventory and that on a line-by-line basis, the goods are valued correctly. You cannot go wrong on this point, and it's quite simple, right? This basically for any inventory point, you can use this when the audit risk is mainly on the inventory valuation. Okay. The next point is a large number of exceptions. Okay. There is an increase of detection risk as this is a recurring issue. Okay. Yeah, I think so too, betul lah, because basically right now is that some of the inventory lines are not being counted. there is an increase of detection risk. Okay, this will result in the inventory being overstated. Okay, I can give one mark, but I want to show you guys my answer here. Okay, using the current inventory count method, okay, some inventory lines will not be counted at all. Okay, and basically we have two different inventory counts. Okay, first is the perpetual inventory count. Okay, for example, IKEA will usually have a perpetual inventory count. What is a perpetual inventory system? Okay, is that basically whenever, let's say, you go to IKEA and then you purchase a table, let's say. So when you purchase a table, and then at the cash register too, the cashier will basically scan this item and then you pay for this item. When the cashier basically has already typed it in the cashier, this will be automatically linked to their inventory system. Okay, so basically the cash till or the cash register is automatically linked to their inventory system and their financial and their basically inventory account lah. So it is all accounted for on real time. However, in a perpetual inventory count, a physical count has to be done at least once a year. Okay, so the impact here is that the inventory could be under or overstated if the perpetual inventory counts are not fully completed. Okay, so basically, the timetable of the perpetual inventory count should be reviewed, and the controls. We want to ensure that the controls over the test counts are they sufficient or not. Okay. Okay, I think I should attend the inventory count and observe the procedure on the counting of inventory. I can give this a 1 mark. Maybe I can give it 0.5 marks because again, you didn't talk about why are we doing this. Okay, we want to talk about the purpose. Okay, we want to ensure that the inventory quantities is accurate or not. Maintaining a professional skepticism is basically whenever there is a risk of manipulation and fraud. In this case, there is no indicator of risk of manipulation or fraud, so we cannot use this point. Next point is on the current asset. Okay, IAS 38 intangible asset states that asset can be capitalized if they meet the criteria of an intangible asset. Okay. The advertisement cost does not meet the criteria of an intangible asset, thus should be expensed off. Okay. This part here is correct. Okay. However, IAS 38 I don't know if it's correct for you to account for this under IAS 38 because this is advertising cost. Kalau IAS 38 is mostly on the research or development cost. Actually, we should not be making any remark to IAS 38. Okay, what you can say is that whenever there's an asset, whenever there is a probable inflow of FEB, only then we can capitalize it as an asset. Okay, however, this point here is correct. It is not. I would say that it should be expensed off. This is correct. Okay, tapi this point here, it did not say that they are actually recognizing it as an intangible asset. In fact, the question said that a current asset will be recognized. Okay, so in this case, I can only give 0.5 marks because I think your explanation here is wrong because basically it's not really related to IAS 38 lah. Okay, like I said, if you're not sure on the IAS, just basically don't talk about the IAS. Okay, if you guys get it wrong, then the examiner may actually reduce your marks there. Inquire the management if the advertisement has been included as intangible asset. If yes, ask management to remove the advertisement. Okay. Basically, we want to discuss with management the rationale of why do they include the advertising cost as a current asset. Okay, and we want to review the reasonableness of this. Okay, instead of you cakap intangible asset and remove basically what you should do is request that management remove this from the current asset because kat sini dia cakap it has been included as a current asset. Okay, and make sure that they expense it off. Kalau buat under IAS 16 boleh ke? Okay. In this case it really depends on the scenario. Okay, guys. In this case, they already specified that they have included this as a current asset. Okay. Even if IAS 16 pun it is a non-current asset, right? So in this case, actually there is no accounting standard, no specific accounting standard that applies. So what you can say is basically just bring in the asset. The definition of an asset. What is the definition of an asset, right, guys? And how can I basically, another way that I can word it is, okay, basically assets are, the advertising cost can only be recognized as an asset if it is virtually certain that there will be an inflow of future economic benefits that can be measured reliably. So in this case, there is no basis for including them as a current asset. Okay, maybe another way that I can say it, right? Okay, in this case, there is no evidence that the advertising costs will bring an inflow of future economic benefits, thus should not be recognized as a current asset. It should be expensed off instead. Okay, I think this is also a more specific point. Okay, somebody said guna relevant accounting standard is okay. Okay, it should be accounted for in accordance to the relevant accounting standards. Okay, basically we just make sure that the management remove the current asset and record the amount as an expense in the SOPL. Okay, so actually your technique here, and we inquire with the management. Okay, and then we make sure that they remove it. Okay, that is actually the technique is correct. It's just that your point here is a little bit wrong. Okay, okay, so this is a good attempt. Okay, I'm going to go through the next example because we're running out of time. Okay. Right. Kita tengok Ain punya revenue for the year. Okay, jap. Revenue for the year is expected to increase. Okay. However, the operating profit margin is expected to decrease. There is a risk of wrong classification of costs. Okay, this is correct. The operating profit margin may be understated and the operating cost may be, okay, I think this should be the cost of sales instead of the operating margin. Okay, it may be that the cost of sales and the operating cost may be misstated. But I can give you 1 mark here because I think you have basically explained the point pretty well. So this is 1 mark. Okay, how do I move this? Okay, I just want to put that small box here. This is 1 mark. Okay, obtain a breakdown of the expenses and assess the nature of the expenses. Kat sini, you will lose 0.5 marks because you did not explain specifically what expenses. Okay, remember I want you guys to be specific. Okay, what expenditure? We want to obtain a breakdown of the cost of sales and the operating cost operating expenditure. Okay, and then we want to assess the nature or basically confirm that it is classified correctly. Okay, so dekat sini is basically 0.5 marks because I think that you were not very specific. Okay, Conico values inventory. Inventory should be measured at lower of cost or NRV. There is a risk that inventory account is misstated. Okay, let me just see my point. I want to open my question side by side. Okay, jap. Okay. Alright, so for the inventory point then, okay, we have to make sure that this is a close approximation to the cost. Okay, we want to make sure that this is correct or not. But I think this is, I can give 1 mark here. Discuss with management in using the appropriate accounting standards. Okay, I think that kat sini kan, I want you guys to make sure to apply this answer here. Okay, because basically whenever we are talking about inventory, we want to confirm the valuation. Is it accurate or not? Okay, so the next point, the directors indicated that at the year end, current asset, okay, assets could only be recognized if there is a probable inflow of FPB. Okay, this is accurate. Okay, this is how you can word it. This is a good attempt. The current assets may be overstated and the advertisement expenses may be understated. And then just like ini siapa punya? Is this Ain? Okay, so this is a good attempt because she did not say any IAS, because even in this case it's very unclear, right, what accounting standard this is under. So we just say according to the relevant accounting standards. This is 1 mark. Okay, obtain a breakdown of the expenses incurred to assess the nature of the expense. Discuss with management in using the appropriate accounting standards in determining the capitalization. Okay, let me look into my point. Okay. obtain a breakdown of the expenses incurred to assess the nature of the expenses. Okay, I think this is actually quite good too. Okay, I think I'll give this 1 mark here. Okay, this here, how you can improve this second point is you have to tell them what they are supposed to do. Discuss with management on the correct accounting treatment. So we will discuss with management on the correct accounting treatment, and we want to ensure that they remove the current asset and record an expense instead for the advertising costs. Pony decided to outsource its payroll function to an external service organization. This service organization handles all elements. Okay, there is an increase of detection risk as it may be difficult for auditor to obtain. Okay, this is 1 mark here. Okay, this is 1 mark. Auditor is to review the monthly reports prepared by the outsourced function to confirm the details of wages and salaries. Auditor may request and review type 1 or type 2 report to confirm whether appropriate controls was in place and whether there has been appropriate monitoring of controls over the payroll. Okay, so this is 1 mark here for this point. Okay, basically your first point and the second point too is quite repetitive lah. So I would say that the second point here is more accurate. Okay, so this is a good attempt. All right, thank you for sending in your answers. Basically, let me just look through my answers for our last few minutes. Let's just discuss whatever that we can. And then whatever yang we tak sempat discuss, I'll just send you guys the inventory plan. Okay, so for the first point here, remember on the external audit team may replace reliance on the controls testing work undertaken by the IA department. Okay, basically, at the start of the audit work kan, if we want to rely on the work of the internal audit, kan, before anything, I want to show you guys, whenever we rely on the work of the internal audit, we want to rely on the work of internal audit, basically, then we will perform a test of control. Okay, then basically, if we perform a test of control and we find out that the internal controls are operating effectively, then basically we will do a reduced substantive procedure. Okay. However, after that, if we perform a test of control, but then the internal controls are not operating effectively, then we will basically conduct a full substantive procedures. Okay. Basically, if we are placing reliance on irrelevant or poorly performed testing, then we may be forming an incorrect conclusion. Okay. We may be basically relying on internal controls that are deficient and basically not strong enough. Okay. So this could result in them performing reduced substantive procedures instead of performing full substantive procedures in this case. Okay, so there is an increased detection risk. All right, basically the audit team should meet up with the internal audit staff and basically read their IA reports to ascertain the nature of the work undertaken. And before actually relying the work of the internal auditor, there are some things that the audit team will have to do. They will have to evaluate and perform audit procedures on the entirety of the work in order to determine whether it is adequate for our audit or not. Okay, and even though we decide to rely on this work, basically the external auditor cannot just immediately take whatever work of the internal audit. We will still have to perform testing. Okay, we will still have to perform testing on the work done by the internal audit team. Okay, and then we want to assess the adequacy. Okay, so next point is the perpetual inventory system. Okay, using the current inventory count, some inventory lines are not counted. So basically, there is a risk that the inventory could be over or understated. Okay. The next point is basically a number of assets which had not been fully depreciated were identified as being obsolete. This is not a very clear audit risk. We've never seen it before, right? But this is an indication that the company's depreciation policy is not appropriate. So depreciation may be understated and profit and assets may be overstated. So we want to discuss the depreciation policy with the finance director and assess its reasonableness. Okay. Inquire if the obsolete assets have been written off. If so, review the adjustment for completeness. Okay. Okay, so similarly, my answer for the outsourcing is it may be difficult to obtain sufficient appropriate evidence to confirm the completeness and accuracy of controls over the payroll cycle. Okay, this is basically where we will relate to the scenario. We want to talk about the payroll. Okay. To confirm the completeness and accuracy of controls over the payroll cycle and liabilities at the year end of PONICO, there is an increased detection risk. Okay, so these points are also points that are repetitive when we are talking about outsourcing to an external service organization. Okay, maybe the last point is basically whenever there is a transfer, okay, we are transferring to the service organizations, errors may have occurred during the transfer process, which have been unidentified. So this could result in wages and salary expenses and accruals being over or understated. So we want to discuss with management the transfer process and any controls which were put in place to ensure the completeness and accuracy of the payroll data. And we will undertake a test of control to confirm the effectiveness of the transfer controls. Okay. Lastly, we want to perform substantive testing on the transfer of information from the old to the new system. Okay, so this one is something you guys should be a pro at already. And we have to make sure that adequate disclosure, and we have to make sure that it's a correct split. Okay, lastly, the most important, I would say, is on the restructuring provision. I hope that you guys can really understand this point, because this one point is a very important point, that even if they don't come out in the audit risk, this may actually come out in your substantive procedures later on. Okay, so before we end the class, I just read through this last point to make sure you guys really understand this. Okay, so again, as per IAS 37, okay, as at the year end, the timing of this announcement has not been confirmed. From the scenario, they said that it may be in May 2025. So we have to talk about if it is announced before the year end, then a redundancy provision will be required as a constructive obligation will have been created. Okay, so we are basically terus applying to the, instead of me going one by one and explaining what IAS 37 requires, I immediately applied. Okay, if the company did not account for this properly, this will result in an understatement of provision and expenses, and an overstatement of profit. So we want to discuss on the status of the redundancy announcement. If it is announced before year end, review the supporting documentation to confirm the timing of the announcement. And maybe we can review the basis of and recalculate the redundancy provision. Okay. So do you guys have any other questions on this, on Pony Coney? So far so good, guys? Semua dah gone, right? 11:40 dah. Okay. So, alright, Iman said good. Okay. So today is basically our last audit risk class. I hope that you guys have actually gained a lot from this too, inshallah. So next week we will be covering on internal control. If you guys have not actually recapped on your internal controls, I will basically be posting, I haven't posted it yet, but I will be posting some videos covering on the different kinds of internal control systems. Okay, so we have 5 main internal control systems: sales, purchases, payables, bank and cash, and what was the other one? Okay, I kind of don't remember right now because they're the last night, the last skip. The other one is inventory, I think. Okay, and NCA. So I will cover these this internal control systems in a separate video that will be uploaded on your Timba flags. So I hope that before you guys come to class, maybe you guys can recap on these internal control systems. Because if I were to recap on the internal control in class, you guys will basically fall asleep. And we will maybe like waste more time on the knowledge part instead of focusing on the exam technique. Okay, so please recap on your internal controls before joining the internal control class next week. Okay, guys? Is there anything else you guys want to ask me before I end my class for tonight? Okay, thank you so much, guys, for joining my spring class. Again, tomorrow we will not have class. Okay, guys? On the replacement class, maybe I will do a poll in the WhatsApp group to kind of confirm on what day will suit you guys best, okay, according to your schedule. So please do this. Please nanti answer my survey because I want to know which date for us to do the replacement class. Okay? Good night, guys. Have a good night rest and take care. Thank you. Good night, guys.
Thank you.
Thank you. Good night.
Thank you, Miss.
Thank you. Bye-bye, guys.